After 4 decades managing capital for some of the largest institutions in the world, I have seen retirement plans succeed, and I have seen them fail catastrophically. And here is what most people do not understand. The retirements that fail, they do not fail because of market crashes. They do not fail because someone picked the wrong stocks. They fail because of 3 specific mathematical traps that most investors never see coming. These traps are invisible. They are silent. They work slowly over years and decades. But by the time you realize you are caught in one, it is often too late to escape. Today I am going to explain these 3 traps in detail. I am going to show you the mathematics of how they destroy wealth. And most importantly, I am going to show you exactly how to avoid them. Because once you understand these traps, once you see how they work, you can structure your retirement to be completely immune to them. Let's begin with the most dangerous trap of all, the one that destroys more retirements than any other single factor. Trap number 1. Sequence of returns risk. This is the trap that nobody talks about but everyone should fear. Here is the core concept. When you are accumulating wealth during your working years, the order in which you receive your investment returns does not matter very much. If you are 30 years old and the market drops 20% in year 1 but gains 20% in year 2, it all averages out over time. You have decades for it to compound. You are adding new money from your salary every month. The sequence does not hurt you, but the moment you retire and start withdrawing money from your portfolio, the sequence becomes everything. Let me show you with a concrete example. Imagine 2 identical investors. Both retire on the same day with exactly $1 million. Both have the exact same investments. Both withdraw exactly $40,000 per year, 4% to live on. Over the next 30 years, both of their portfolios earn an average annual return of 7%, identical average returns. But here is where it gets interesting. Investor A, let's call him the unlucky retiree, experiences terrible returns in his first 5 years of retirement. The market drops, stays flat, struggles. Then in years 6 through 30, the market does great. Investor B, the lucky retiree, experiences the exact opposite. Great returns in the first 5 years, then mediocre returns for the rest of retirement. Same average, just reversed order. What happens? Investor A, the unlucky one, runs out of money completely by age 85. His portfolio goes to zero. Investor B, the lucky one, ends retirement at age 95 with over $2 million. Same starting point, same average return, same withdrawal rate, completely different outcomes. Why? Because Investor A had to sell shares at depressed prices during the early years to fund his withdrawal. He permanently reduced his share count at exactly the wrong time. When the market finally recovered, he did not have enough shares left to benefit. He had locked in losses. Investor B, on the other hand, had great returns early. His portfolio grew even while he was withdrawing. By the time returns slowed down later, his portfolio was large enough to handle it. This is sequence of returns risk, and it is the single biggest threat to your retirement. You cannot control what the market does, but you can control how exposed you are to this risk. The solution is structural. You build what we call a bucket strategy. You keep 2 to 3 years of living expenses in cash or very short-term bonds. This is your safety bucket. If the market crashes in year 1 of your retirement, you do not care. You do not have to sell a single share of stock. If you retire with $1 million and inflation averages 3% per year, by the end of a 30-year retirement, you need $2.4 million to have the same purchasing power you started with. Your $1 million, if it just sat in cash, is now worth about $400,000 in real terms. You lost 60% of your wealth. Not to a market crash, not to bad investments, to inflation. Silently. Inevitably. Now most people say, but I am invested in stocks. Stocks will grow faster than inflation. And that is true on average over very long periods. But in retirement, you are not just holding stocks. You are withdrawing from them. You are spending 4 or 5% per year. If your portfolio grows at 7% and inflation is 3% and you are withdrawing 4%, the math starts getting very tight. One bad decade and you are in trouble. Here is what most retirees do wrong. They treat inflation like it is a constant 3%, but inflation is not smooth. Some years it is 1%, some years it is 7%. If you hit a period of high inflation early in retirement, the same sequence of returns problem applies. Your withdrawals in high inflation years feel larger. You are taking out more nominal dollars to maintain your lifestyle. You are depleting your capital faster. The trap is assuming inflation will be low and stable. History tells us it is not. The 1970s saw inflation average over 7% for an entire decade. If that happens again during your retirement and you are not prepared, you will be forced to cut your standard of living dramatically, or worse, you will run out of money. The solution is twofold. First, you must own assets that have inflation protection built in. Tips: Treasury inflation-protected securities are designed specifically for this. Infrastructure assets, real estate, commodities. These are real assets that tend to rise with inflation. Second, you must plan your withdrawal rate assuming higher inflation than the historical average. Do not plan for 2%, plan for 4%. If inflation comes in lower, great, you have a margin of safety. If it comes in higher, you are protected. Inflation is the silent thief. It does not announce itself. It does not make headlines until it is too late. By the time you notice your money does not go as far, years of damage have already been done. Do not fall into the inflation trap. Plan for it. Protect against it. Build it into your structure. Trap number 3. The longevity trap. The third trap is the one people understand intellectually, but fail to internalize emotionally. You are going to live longer than you think, and that is financially terrifying. When I started in this business 40 years ago, we planned for retirements that lasted 10, maybe 15 years. You retired at 65. You lived to 75 or 80. The portfolio just had to last that long. Today, medical science has changed everything. A healthy couple retiring at 65 today has a 50% chance that at least one of them will live past 90. A 25% chance one of them hits 95. These are not small probabilities. These are coin flips. If you plan your retirement assuming you will live to 85 and you live to 95, you just added 10 unplanned years, 10 years of expenses. If you do not plan for it, it will destroy you. The solution is conservative planning. Do not plan to age 85. Plan to 100. Yes, that sounds extreme, but it is the only way to be safe. If you plan to 100 and die at 90, you leave money to your kids. That is a good problem. If you plan to 85 and live to 100, you spend 15 years in poverty. That is a catastrophic problem. Also, consider longevity insurance. This is a specific type of annuity that starts paying you at age 85 or 90. You pay a relatively small premium now. If you live a long time, it pays you for life. If you die early, you lose the premium. It is insurance. But for many retirees, it is the cheapest way to eliminate longevity risk entirely. The longevity trap is about respect. You must respect the possibility that you will live longer than average. You must respect the exponential growth of healthcare costs. You must respect the mathematics. Hope is not a plan. Optimism is not a strategy. Planning for longevity is. Now let me tie this all together. Because these three traps do not operate independently. They interact, they compound each other. Imagine you retire and immediately face a market downturn. Sequence of returns risk activates. You are withdrawing from a falling portfolio. At the same time, inflation spikes to 5%. Now your withdrawals have to increase to maintain your lifestyle. The inflation trap activates. You are pulling more money out of a smaller portfolio. And you live to 95 instead of 85. The longevity trap activates. Your money has to last 10 extra years. All three traps working together. This is not a hypothetical. This happened to retirees who retired in the early 2000s. Market crash, rising healthcare costs, longer lifespans. Many of them never recovered, but the retirees who understood these traps, who built structural defenses, who had cash buffers and inflation protection and conservative longevity planning, they survived, they thrived, they thrived. The difference between the two groups was not luck. It was preparation. It was understanding the enemy is. So what do you do? How do you build a retirement that is immune to these traps? First, implement a bucket strategy. Keep 2 to 3 years of expenses in cash. This eliminates sequence risk. Second, allocate 10 to 20% of your portfolio to inflation-protected assets. Tips: real assets, commodities. This neutralizes the inflation trap. Third, plan your withdrawal rate and your time horizon conservatively. Assume you live to 100. Assume inflation averages 4%. Build in margin for error. If you do these three things, you have built a fortress. You have removed the silent killers. Your retirement can now withstand almost anything the world throws at it. I have spent 40 years watching retirements succeed and fail. The ones that fail almost always fall into one or more of these three traps. The ones that succeed understand these risks and plan around them. You now have the knowledge. The question is, will you act on it? Take this week to audit your plan. Look at your asset allocation. Do you have a cash buffer? Do you have inflation protection? Or are you planning conservatively for longevity? If the answer to any of those questions is no, you have work to do, but you still have time. Do not wait until you are 75 and trapped. Do it now while you still have options.